tax standpoint. And also the Fed's made some pretty big moves this week. So let's get into it. And if you're new to the show, what we're going to cover today is unemployment. We're going to cover Fed decisions, elections, housing, inflation, and even the stock market indexes. So let's start off with the economic mapping that I put together back in February. Now we're on version 3. And as you can see here, there's been some changes that I've made based upon the forbearance, based upon the delay in the updated stimulus packages like the PPP and the unemployment and the rent delay. And so I've made some changes to this, but basically everything has just been pushed ahead about 2 months. There's not much that has changed as far as what I am mapping out and what I believe is going to happen. It's just going to be a little bit delayed. So the one big thing I want to bring up is what I call the triangle volatility, and then also the risk of the forbearance or the foreclosures. Again, in this period of time that you can see outlined by the triangle, I'm fully anticipating somewhere between November and December to have a lot of volatility within the market. Also, hedge funds, institutional managers, with this kind of growth in the stock market, they're going to be looking to take some gains. In addition, depending upon who gets in on the election and what the tax programs are going to be, if Biden gets in, we can expect a very rocky road at the beginning just because of his proposals on capital gains tax changes, which he is going to basically increase capital gains taxes by 100% by simply changing the way that they're taxed as ordinary income. You've heard me talk about IRAs and about how when you hold the wrong investment in the IRA, and if it's a stock, you're literally doubling your tax. This is what's going to happen on all money. Also, we see this circle, which is going to be the forbearance and when real estate really kind of comes home to roost. So what are some of the tax proposals? Well, some of the most recent ones that have been added on since last week are there is a proposal in Congress right now to eliminate, and Biden is behind this with the Democrats. And so if Biden gets in, this is what we might see, which is a complete elimination of any 401k or IRA before tax savings. They need tax dollars in a big way. And in the next webinar that I'm going to be covering, which is called the IRA tax bomb, and you're going to see exactly what I've been talking about for years. There's this giant amount of money that's sitting in deferred accounts, and the IRS, Congress, needs money, especially when you're talking about $1 trillion in annual deficit, and what is it now, $23 trillion in national debt deficit. So they're in some hot water financially, and they have to figure out how they're going to get that money back. One of those is they're going to have to change up retirement plans. Now, what's interesting is they show the tax revenues, and there's been some projections made. Even Wharton School of Business did some projections in comparison to the government. The government, from the Democrat side, is in favor of this complete elimination. Essentially, it turns everything into a Roth, but there's going to be limitations. You'll only be able to put a certain amount into a Roth, which has tax-free growth. And then the rest, just like now, you might still be able to put $20,000 or 19, whatever it is this year, into a 401k. You just won't get the deduction on it, but your growth will be deferred, but you'll pay tax on the growth when you go to take it out. So there's some big changes on the tax horizon. We just don't know what those are yet. There's also big proposals in Congress to change the way that Social Security is distributed, mainly because right now they've had to back down that 2034 bankruptcy date down 2 years. And in addition, if they reduce or eliminate the payroll tax, which is a proposal right now to get the economy spurred, it could essentially, if they eliminated the payroll tax, it would bankrupt Social Security by 2023. It's already a $45 trillion or $43 trillion deficit in debt, right? So let's talk about what happened with consumer spending. Consumer spending went up by 1.9% in July, which is a positive, but I think it's a false positive because we can probably expect a dismal result in August, only because those results were because people were still getting higher unemployment and they still had the stimulus check. Positive is there's net consumer per capita income increase by 0.02%, and that's after 2 months of decline. So that's a positive on the upside for those people that are working. Now, on the unemployment side, there's 1.006 million people that filed for unemployment. The good news is that's down 98,000 from the prior week. Unemployment is now down. As you can see, I'm kind of tracking the downward trend here. It's down to 9.9%, and that relates back to the highest point at 14.7% in April. Only 5 states right now are utilizing the additional $300 per week in unemployment. And California, as California normally does, they're playing the politics. And they were actually delayed in applying for the additional federal aid by 20 days. I don't know if they're just trying to claim victim yet again, but this is their little game. Unfortunately, the politicians, they all have nice incomes, nice houses. I think Pelosi was eating, $10 or $12 ice creams out of her $5,000 refrigerator, but, they can't apply for the additional federal aid to help those people that are hurting. Anyway, let's talk about something else today, which is a lot of conjecture on what's happening with the virus. Now, we know that our country was a little late to shut down, and we allowed government allowed it to happen state by state, depending upon what the state's mandates were. We know that certain states like New Jersey and New York, they kind of used a blanket draconian methodology of just shutting everything down. We know that certain states like California are still in a shutdown. We know that other states like Montana and Utah, Wisconsin, South Dakota, they used very lax shutdowns. Now, when you read something in the paper, I get a little frustrated because there is a simple way to trick the numbers on any kind of news release to make people believe something or not. A great example is, I never forget this, that I was watching the Super Bowl. Now, this goes back a long time, and a mutual fund company had produced their results, and they put them on TV. And I didn't believe that they had these kind of results, so I looked it up and looked the detail in it. And what I found is that they used a starting date at the lowest point after the crash of 9/11. So you can play with the numbers any way you want. If you see an ad that says, or you see a news article that says, Sweden as an example, highest death count or increasing death count. Well, here's what I want to show you this, just so you really understand how to break down the numbers so that we're really looking at true calculations. So whether you're using this number in your investment management, in your tax management and efficiency, or even just trying to create an economic map like I do, you have to use truth in numbers. And you can't be fooled by so much of the garbage media that's out there today. So you probably heard that we in the United States were diametrically different, completely different than Sweden. Sweden took a very different approach to the virus. And what they took is the idea that, hey, we're not going to shut down our economy. We're going to use social distancing. We're not going to require people to wear masks. Now, when you look at the difference between the deaths per million, the United States is in 11th at 559, and this is as of actually 2 days ago. And Sweden is at 576. Now, I mean, they're 2 points above us, but we also have to look at they had no economic shutdown. They have no mask requirement. There's proof now that they're developing some of their herd immunity. So again, we have to be very careful with what we look at. Well, let's jump over to the Fed decisions. And the Fed decisions, we see that we have unemployment, we have the PPP, student loan, stimulus checks, rent and forbearance is still in Congress. Now, they're not due to reconvene until September 8th. Pelosi has threatened to bring them back on non-related issues, which have nothing to do with them voting to get this fourth stimulus package through, which I think is absolutely ridiculous because there are people out there that have not, they don't have food. They don't have money to pay their electric bills getting turned off. There's some people that are really hurting out there. I wish Congress on both sides of the aisle would just pull it together and make some compromises and get this thing done. My worry is that, the Democrats are just asking for way, way, way too much. And the Republicans, on the flip side, they're not following the 1929 crash playbook. And that showed that when they tightened money, they didn't put money into the stimulus. We went through another recession, another crash. So we're going to know a lot more on what some of the actions and outcomes should be on September 8th. Okay, let's take a look at the virus outcome. We now have 23 companies in phase 1. We have 14 companies in phase 2. We have 9 companies in their final test. 2 companies approved for limited use and 0 companies approved for 100% full use. We are getting closer. We estimated at the beginning of this virus, this pandemic, that somewhere around November, December, latest January, we would see some kind of vaccine to help those people that are sick. Economic indicators, interest rate, not a lot to really key in on here that's changed a lot. The only difference is the mortgage rates have dropped just a little bit, and a lot of that has to do with supply and demand. It doesn't have anything to do with the Fed fund rate. It's really supply and demand, so it's dropped back a little bit. But here's the good news, and I'll tell you this a little bit later too. We'll key it in. FHA and the Feds have agreed to delay the 0.5% refinancing risk premium until at least December of this year. So that opened up the floodgates and said, hey, a lot more refinances are in order. Big news this week is the Feds are now abandoning the Phillips curve. Now, if you don't know what the Phillips curve is, this was developed back in the 40s and 50s and ratified back in the 60s as to the Fed policy as to how they monitor and they adjust interest rates to keep inflation under control. It was originally believed, even back from 100 years ago, that inflation was created by low unemployment. So the more people worked, the more that they had to earn, the more that they would spend. Well, now with the pandemic, they've actually researched this and they found out that low unemployment is not an indicator of inflation because people will put money on credit. Some people hoard cash. Some people even spend more because they adjust their paradigms, as we've talked about for many, many, many weeks now, the paradigm shift. The Feds plan on keeping interest rates low. What that's going to do is it's going to create a very hot economy. That economy is going to help increase jobs, right? So that is good for the stock market. So a lot of people that are looking at the stock market and saying, I don't understand how the stock market can keep going up with this pandemic. It's because there's other factors. Remember, the stock market is always looking 6 months to 12 months in advance. If the Feds are saying that they're going to keep interest rates low, then there's a positive because more companies can actually they can borrow more money, they can issue stock, they can grow without the constraints of high interest rates. Now, it is negative for the bond markets, but here's a positive. Many of you that work with us, you know that we switched over to TIPS about 45 to 60 days ago, and that was based upon what I was reading in our mapping, essentially, that inflation was going to go very, very high. So we may even do more moves to reduce bonds and allocate more towards TIPS. It's also a good short-term, if you buy the right TIPS with the right maturities and do it the right way, it's also a good short-term, meaning 1 to 2 year portfolio allocation. The paradigm shift. Life has changed. You know, I read all this stuff and people say it will go back to the norm. No, it won't. If there's one thing I've learned over 36, is it 37? Anyway, it's been a long time. Is that when these things shift, they don't go back. People grow and they create new habits and new beliefs. And I think it was Einstein that said, what is the one thing that's harder to crack than an atom? It's a belief. So now if people believe they're at risk in big cities, they're going to move to suburbs and rural areas. If people believe that it's unsafe to go to movie theaters and restaurants, they're going to order things online. If people believe it's safer to stay at home and do a staycation than it is to go on an airplane, they're going to buy things at Home Depot and Best Buy to improve their home. This is not going to change. While it will balance out a little bit more, people now have become into a new norm. And what that does for us, as people that are looking at how the future is going, again, you have to look as if you're a ship captain. You know, a lot of people just say, well, if you're a ship captain, if you're managing money, you just take the straightest route every single time. And, you know, if you have a ship that you have bought and it's got a huge expensive cargo, and you hire a ship captain and you say, I want you to go from the port of Miami to the port of Dover in the UK. And you can chart an exact straight line. However, what's going to happen is currents are going to change, wind is going to change. You might even encounter some bad storms and hurricanes. So what you have to do is you have to adjust that navigation. You have to adjust to get to your destination without letting your ship sink. And right now, there's a lot of people out there that are saying that it's all going to go back to the norm. Just, you know, utilize the old strategies, stay the course. That does not always work. I'll give you a great example of this. if you haven't seen that Warren Buffett just made $35 billion in Apple. Now, if you remember the great Omaha, Nebraska, the Berkshire Hathaway annual meeting where he was not in tech in 97 and 98. And I don't know if you remember watching this. Well, maybe I'm the only geek that watches these things. When they asked him why, he held up a big zero like this. And he says, this is my circle of influence. This is my circle of understanding. And I don't go outside that. Well, that means he wasn't anywhere in tech. And everybody criticized him. But when tech crashed, no one criticized him. However, once he started to see the new direction, he got rid of a lot of stocks that were dead ducks. And he reinvested into what? Technology. So again, the old buy and hold mentality does not work long term. There's statistics that will show that things go in style and out of style. We look at the Dow. None of the original Dow are the same stocks that were there when it was created in the 1920s, right? We also saw some of the pharmaceuticals getting switched out of the Dow last week. We saw Salesforce.com, which is a CRM for businesses, get accepted into the Dow, and we saw Raytheon get kicked out. So again, it depends on what direction we as humans are going, where we're spending our money, where our beliefs are. So again, life has changed. We have all these new services and things have changed. So question is are you adjusting your investments, your tax strategy, all of your cash flow strategies to adjust to this new strategy? Well, again, I don't believe that the old concept of just buy 50% S&P 500, 50% aggregate bond index is going to work anymore. We already know the Feds have completely changed their game on inflation, which means that bonds have a completely different game to meet. Let's talk about something I've been getting a lot of emails on, the digital dollar. Look, let me explain. I am so opposed to some of this trash media. And just go on MSNBC or go on Internet Explorer. The worst culprit is Yahoo. If you go on Yahoo Finance, just scroll down and you're going to see the most garbage media advertising. And they're all the same culprits. They say, man that predicted Amazon's growth has the next prediction of the world coming to an end. Man that predicted Yahoo or Facebook predicts that all currency will collapse. I mean, what they're trying to do is they're trying to get you to buy their newsletters. And it's a really frustrating situation because people actually email me and they'll say, Ken, is the government going to confiscate our money? Ken, are we going to lose all of our currency? So I want to focus on one thing today, which is the digital dollar. Look, the Feds have been working on this through MIT for years, I think 10 years now, since Bitcoin was actually created. They knew that they wanted a more secure way of handling currency. So we plan on digital currency being accepted in about 3 to 4 years. Now, when I say digital currency, I'm talking about a physical digital coin. People don't understand that. We are right now about 92% digital anyway. There's very little currency floating around. And now the virus, I went to do a car wash the other day and I had $10. I went to hand it $10. The guy's like, no, we don't accept cash anymore. It's only digital. It's like, well, okay, well, there you go. So now because of the virus passing through paper, people aren't accepting paper anymore. So again, what I want to do is tell you, don't worry about this garbage media that's saying that the world is going to collapse because the government's going to confiscate your money. It's all going to turn into digital. So right now, there are digital coin policies that the Fed has outlined with the development of this new digital coin. Number one, the minting of that is going to be controlled by the Feds. The positive is that it will really control a lot of the problems that we have with currency right now. However, if you are an investor in USDT or TUSD, those are stable coins backed by the US dollar. That might be pretty risky because if the Feds do come out with a Fed coin, I don't know what's the direction of USDT or TUSD is going to be, but it's probably going to be detrimental to your financial health. So one of the reasons that I like this idea of going to a Fed coin is some of the problems. What do they say? 90% of all currency is infected with cocaine, right? We know that it passes diseases and it passes whatever. So you're wondering, why did I pass that $10 to the car wash? Because it had been sitting in my safe for probably about 5 years. And I thought, okay, well, this is safe. But the guy accepting that didn't know. But it will. The Fed coin will also get rid of, the money laundering, the drug money, human trafficking money. When you take it out of currency where people can pass paper, and now it has to be handled by a digital wallet that goes through the Fed, then, and some people are saying, but I don't want the Fed to know everything. Look, they know everything anyway. I'm sorry, but if you haven't read the reports on what the NSA tracks, if you haven't read how, we as registered investment advisors with the SEC, we have to report to the Feds, to the OFAC, to anything that we see that might seem a little bit odd. So unless you're a drug dealer, and if you're an honest person and you're dealing with the banking and the brokerage system right now, hate to tell you, but they know everything anyway. It's all recorded. So the Fed coin is just going to clean up our system even more. So if you ask me if I'm in favor of it, absolutely I'm in favor of it. It'll get rid of some of the loss of our currency, the counterfeiting that depreciates our dollars, right? The drug money that depreciates our dollars. All these bad things that come along with paper currency will go away. The other advantage is that the Fed coin will also be able to be traded on the markets, the public markets, just like Bitcoin does. And then there's also no more expensive conversion. Right now, if you trade in Bitcoin and you try converting back to US dollars, there's pretty hefty fees on doing that. So the Fed coin will eliminate that. Albeit why the stable coins may not be around anymore. Let's talk about real estate. So 8.4 million mortgages in forbearance. People are fleeing the cities to go to the suburban and the rural areas. And there's the deferral of the risk premium of the 0.5% into December. Just read what's going on, and you go back into my broadcast that I did back in February and March. These are things that I outlined. I outlined it was no different than in 9/11, right? When people were afraid to death of a terrorist act, this is no different. The difference is now people will continually be afraid of the virus because we are going to have a very low and long saturation rate with the vaccine. We've already seen the statistics that 50% of people said that they will not take the vaccine. They're afraid of the side effects. Or, I had one guy said, haven't you seen any of these movies where the vaccine turns everybody into zombies? I don't know. Look, I have no idea what that will hold. I just know that when you poll 50% and 50% of people are saying that they're not going to adopt the vaccine quickly, we know it's going to be a little bit longer until even people get back to some balance. So that paradigm shift is going to be stronger. My belief is it'll be stronger for a longer period of time than it even was with the terrorist acts. Hey, let's jump into the S&P 500 performance. As you see there, ending 827, we're up 6.9%. And if you compare that back into 2018, we're down 4.38. Again, a lot of people can't believe this is happening with the stock market when you still see, close to 10% unemployment and all these people are hurting. But there's other factors that are at work that is making this market go up. And, a lot of these factors are not false factors. People are saying, well, the market is overpriced. Well, show me where the market on a PE ratio is overpriced. Are you saying it's overpriced because of the actual dollar amount? But remember, everything that we do is a price to earnings ratio. It's a valuation of the value. And right now, we are not seeing that now. Are we seeing that with certain stocks, like Tesla or other stocks? Yes, we are seeing that. But as a general broad market, no, we are not seeing any kind of overvaluation. I'll tell you when there was an overvaluation where I screamed bloody murder, it was back in 2006 and 7 when real estate was pumped up so high, I just could not foresee any kind of outcome. Now, do I think that there's going to be some volatility? Yes, I've already mapped that out. I believed originally it was going to be October, and I still believe a lot of our volatility will start in mid-October. That does not mean you're going to time the market and try to sell everything out and then buy back in when you think or know the market is at a low. It just means we're going to go through that volatility and we're going to continue our techniques of tax balancing, tax harvesting, swapping, rebalancing. These are all techniques that if you've been with us, you already know. March, April, we did that, and boy, has that ever worked out well. So actions to take now. Number one, Change the portfolio to a paradigm shift portfolio. Do not believe the old mentality of just buy and hold or broad-based indexes and don't change them. Hey, look, here's one thing I want to say. For all those people that are just broad-based indexes and don't change anything, the S&P 500 is 6 months to a year behind the curve, right? They bring new stocks into that 500 index only after market weightings and caps, right? And performance. But they don't buy them. They don't put stuff into the S&P 500 when it's undervalued with the potential for growth. They bring it in after it has a certain market weighting cap, right? And so if you know that things are shifting, you can't just stay with just a broad-based S&P 500 because it's going to be late to the game, and they usually are. It doesn't mean I'm telling you actively manage. It doesn't mean I'm telling you actively trade. Just include other types of ETFs and indexes in your portfolio mix, which is what we've done with that new portfolio, to accommodate for those portfolio shifts. Sell real estate. Yeah, right now is a wonderful time to sell it. The market is hot. Interest rates are low. Hold on to the money. Rent for a year. Consider tips as a cash alternative right now for short-term 1 to 2 year money. Here's another one I'm going to be covering on some of my upcoming webinars, and I'm actually going to probably put together a specialized course on reverse mortgages because, I can tell you there is so much in misunderstanding. So, I'll give you a great example of this. I had a client back in 2006, and he had a house in California, and he was, 70 years old at the time or so, and he had a $350,000 house, and he had a $179,000 mortgage on it. He asked me what I should do, and I said, reverse mortgage it. Get that forward mortgage paid off so you don't have the risk, the downside risk. And, I've heard about reverse mortgages. They're terrible. They steal your house and all these other misbeliefs. And I said, I'm telling you, this is a good deal. Do it. He didn't do it. And when the real estate market crashed, his $330,000 house was now worth $150,000. He still owed the $179,000. That house I've been watching it, it's just tracked over $200,000. And so again, reverse mortgages have a lot of downside protection, but there are some negatives with it, but you just have to understand those. So I'm going to be doing a separate course on that. But right now, because interest rates are so low, it is a spectacular time to look at and analyze whether a reverse mortgage is right for you or not. Prepare for a buyback. I got a lot of people that are switching houses, and I'm not opposed to that. I had a client not too long ago call me and say, I know you told me to wait until July of 2021, but we're stuck at home. And I said to my client, I said, look, the bottom line is money is there as a tool. If you haven't heard me say this before, if you don't use it and enjoy it, and I use this statement, if you don't fly first class, your children or grandchildren certainly will. And so this is a whole new generation of people that believe, hey, I paid for my kids' college, I paid for all this, whatever is left over when I die. If there's something there, great. If the last check to the funeral home bounces, hey, I'm out of here, right? So it's now time to look at, hey, could you upgrade your house right now? Is it the optimal period of time? I don't believe so. But look, life is short. That's a year away, right? So if you could upgrade your house, do the analytics on it, do the calculations on it. If you're using us as your, oversight managers, your wealth managers, contact us and we will do an analysis of how much of a house you can buy, upgrade your house without you running out of money. And that's the goal, to enjoy the money, but just don't run out of the money. Search in rural areas or suburb areas, not cities, if you're going to be planning on, if you're tracking of where to buy that real estate. Because again, just like any real estate, as most of you know, I've been an avid real estate investor now for 35 plus years, almost 38 years. And the key to my success in real estate has always been, I go where the building is going. Wayne Gretzky said it the best. I don't skate to where the puck is. I'm going to skate to where the puck is going. Same thing with real estate. You do not want to go into New York City now and say, I'm going to buy up a whole bunch of real estate because it's 30% depressed. Where is the money going? It's going to the suburbs. It's going to the rural areas. It's hot. And so that's another way to look at where to deploy that money. Pay back any accelerated RMDs or 401ks because the rules from the Department of Labor and the IRS have changed. And most likely you are not going to qualify for the virus crisis, the CARES Act exclusions on taking those additional monies out of your retirement plans. Plan for massive election volatility. And I'm going to show you, we got a webinar coming up called Election Protection. And lastly, change your trust because of the Secure Act. Again, we also have a webinar that's coming up on that. And speaking of the webinars, here we go. We have some new online webinars that are going to introduce you to some of the specialized information. And all you have to do is, as you see in the bottom left of your screen, go to hhrdm.com, look for the More tab, and then just choose on there More, and then choose, it says Events, and then Retirement Webinar Series. And you're going to see 10 webinars that are coming up in the next 30 to 40 days or so that you can schedule for. Now, my suggestion is this: if you want to attend that webinar, reserve as fast as you can, because each webinar, just because of the technology that we're using, we are going to be limited to the first 100 reservations. And so you actually are getting the reservation opportunity before this actually goes out to the public. We have not released this right now, so it's first come, first serve. And lastly, depending upon where you're joining us, if you're joining us on Facebook, if you're joining us on YouTube or Facebook, you can subscribe to our channel. And if you're on YouTube, you can see it right there. You just click on the red button. Lastly, just call us if you've got some questions. If you're working with us already and you want to have your planners do some of these analysis, give us a call. We'll schedule a time with you. Everything right now is virtual, so we're doing Zoom meetings. This way you can see the screen, we can see you, you can see us. It's just like being there without the risk of the virus. If you've got questions, you can also just email us at support@hhtba.net. Hey, with that in mind, have a safe weekend. We're getting here to the fall, and so a little bit cooler weather, hopefully. It has been hot, really hot, hottest in history. So those people that say there's no global warming, I just read that 27 trillion tons of ice has melted in the last 8 years. You live in Vegas at 104 average per day, you believe global warming is here. With that in mind, stay cool. We'll talk to you next week. Bye-bye.